Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning. I hope you had a great weekend. Welcome to the new working week. This is Peter Lewis with Money Talk for Monday, the 26th of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, Fed Chairman Jerome Powell said Friday the time has come for the central bank to cut interest rates. Mr. Powell said in a speech during the annual economic conference in Jackson Hole, Wyoming, "My confidence has grown that inflation is on a sustainable path back to 2%. On the labour markets, Mr. Powell said we don't seek or welcome further cooling in labour market conditions. Mr. Powell stated the balance of risks to our mandates has changed and upside risks to inflation have diminished, downside risks to employment have increased. Bank of Japan Governor Kazuo Ueda warned on Friday that global markets remained unstable as he reaffirmed his commitment to raising interest rates should the country's inflation and economic growth remain on track. Mr. Ueda said concerns about a slowing US economy caused the recent market rout, and they are closely watching market moves with a sense of urgency as uncertainties remain, while reaffirming that there's no change to the central bank's monetary policy. Kamala Harris formally accepted the Democratic presidential nomination, vowing to unite the country if elected. She pledged to lead for all Americans and create an opportunity economy. She promised to confront China, Russia, Iran and Iran-backed terrorists and to make sure that the US military remained the most lethal fighting force in the world. Mrs. Harris said that as president, she would ensure America, not China, wins the competition for the 21st century. Alibaba Group said it would alter its listing status in Hong Kong in a technical move that qualifies the e-commerce and technology giant to sell shares to mainland China's 220 million stock investors. Alibaba will switch from a secondary listing to a primary listing in Hong Kong from August the 28th, making it dual primary listed in the city and on the New York Stock Exchange. The move will allow mainland Chinese investors to invest into the e-commerce group via the southbound Stock Connect with Hong Kong. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and John Schofield, Managing Director of Tempus Investment. Providing a view from mainland China will be Ben Cavender, Managing Director at the China Market Research Group. And as always, the latest update of my Asian Daily Business newsletter is available on my website at peterlewismoneytalk.substack.com. On Wall Street Friday, US stocks surged as Jerome Powell signalled the Fed was moving closer to a rate cut and all but ending the central bank's inflation fight. That sent the MSCI All-World Stocks Index to a record high. The global benchmark hit its highest level since January 2022, after rising nearly 12% since its low on August the 5th. The S&P 500 rose 1.2% on Friday to 5,635, with gains accelerating late in the session. The rally left the broad-based index just 0.6% off a record close reached on July the 16th, as every sector advanced on the day. The Nasdaq Composite added 1.5% to 17,878, as every Magnificent Seven group except Meta rose. The Dow added 462 points, that's 1.1%, to end the day at 41,175, the second highest close on record. The small cap Russell 2000 increased 3.2%, that's its best one-day gain in a month. And each index notched a gain for the week. Both the S&P 500 and Nasdaq advanced 1.4% over the 5 sessions, while the Dow gained 1.3% for the week. Treasury yields tumbled, led by the short end. The policy-sensitive 2-year yield dropped 12 basis points to 2.91%. For the week, yields are down 15 basis points and 35 basis points lower since the start of the month. The yield on the 10-year note fell 7 basis points to 3.80% Friday. The US dollar index tumbled sharply, falling below its December 2023 low. It ended the session 0.8% lower. Over the week, the dollar index was down 1.7%. The Aussie dollar, Kiwi dollar and Japanese yen made the biggest gains against the US dollar. The yen surged 1.3% against the dollar to 144.37 yen per dollar. The offshore yuan appreciated 0.4% to 7.1162 renminbi per dollar. Brent crude oil ended the day 2.5% higher at $74.83 a barrel. The risk-on sentiment helped Bitcoin surge above $64,000 at one stage Friday. It ended the New York session 5.5% higher at just above $63,700. For the week, the cryptocurrency rose 7.7%. Hong Kong stocks traded in negative territory Friday, but in a narrow range. The Hang Seng Index closed just 29 points lower, or 0.2%. At 17,612. For the week, the Cities benchmark index rose 1% for the third consecutive weekly gain. The tech index was 1.1% lower Friday, but gained 0.33% over the week. Mainland Chinese shares hit a fresh 6-month low before rebounding. The CSI 300 reversed losses of 0.2% to rise 0.4%, closing at 3,327. And this morning, the Hang Seng projected to rise about 100 points, starting the day at 17,715. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
This is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Alex Wong, Director of Alex KY Wong Asset Management. Morning to you, Alex.
Good morning, Peter.
And also with us is John Schofield, Managing Director at Tempus Investment. Good morning to you, John.
Yes, hello, good morning, Peter.
Fed Chairman Jerome Powell said Friday the time has come for the central bank to cut interest rates. Mr. Powell said in a speech during the annual economic conference in Jackson Hole, Wyoming, "My confidence has grown that inflation is on a sustainable path back to 2%. The Fed chief said the direction of travel is clear and the timing and pace of rate cuts will depend on incoming data, the evolving outlook and the balance of risks. On the labour markets, Mr. Powell said, "We do not seek or welcome further cooling in labour market conditions." Mr. Powell continued to note how the Fed's attention had shifted within its dual mandates as he stated the balance of risks to our mandates has changed and upside risks to inflation have diminished, downside risks to employment have increased. But he pushed back against concerns about another recession in the near future, arguing that the rise in unemployment was consistent with a slowdown in hiring, but not a sudden spike in job cuts. He said there's good reason to think that the economy will get back to 2% inflation while maintaining a strong labour market. So, Alex, the central bankers all left Jackson Hole, slapping themselves on the back and congratulating themselves that they've avoided a recession and they're on track to achieve a soft landing. Are they right to be optimistic about that?
I think they probably should still be optimistic. I think the rate of job losses actually is not that scary right now, and they are acting fast to try to contain the unemployment situation. And then the inflation, I think, is still under control right now, and we are seeing softness in commodity market. Actually, oil remaining a little bit soft. So I think the scenario actually is quite okay right now. So we probably may see this to continue for a while because I think the expectation probably would have changed a little bit, unless we are back to the inflationary scenario because of the election. Otherwise, I think right now it's looking quite good.
So you're really saying very similar things to what Jerome Powell himself said and what Andrew Bailey, Governor of the Bank of England, said. They really dismissed the idea that growth is going to need to be sacrificed to reach their inflation goals. You're really on side with that, it sounds.
Yeah, right. I think China actually plays a part because I think China actually is still in a deflationary situation, and then and actually China is still a very important part in the global supply chain. So I think that actually contribute to the softness in the inflation. So if they don't impose a huge tariff or or start a new trade war, then I think we probably would be okay.
John, are you as optimistic as Alex is, as the Fed is, and as the Bank of England is?
Well, I think if anything, I think he's right to highlight the change of the balance of risks. And I think, partly following on from what Alex was saying, I think the risk of deflation picking up pace is now quite strong. We can continue to see deflation coming out of China, as you said. The impending or ongoing almost collapse in some basic commodities like iron ore, steel, coal, and oil is, I think, still probably higher than it would otherwise be due to geopolitical issues. But what we're seeing is all these and the slowdown in German economy also, and Europe generally is all heading in that direction. So I think the inflation is going to prove to be more than under control. So, but he's in a good position, I think. Still at 5.25%. We haven't even had the first rate cut yet. So if necessary, they can pick up the pace on cutting rates if the deflation and the employment situation continues to worsen.
It's interesting you're concerned that actually we could be heading towards deflation, which means that really interest rates are way too high, aren't they? Because, you're sort of echoing what the president of the Chicago Fed said, Austin Goolsbee. He said, I'm concerned that we're the tightest we've been this cycle. Inflation-adjusted interest rates have risen as price pressures have eased. So that leaves interest rates quite tight, and you only want to be really that tight if you fear overheating.
Yes, that's right. People have been saying for quite some time that the Fed's was too slow to start cutting interest rates. I don't necessarily agree with that either. But yeah, the bond markets particularly are telling us that bond yields anyway are we have a very steep inverse yield curve. We're going to start. So we're starting to see prices of basic commodities falling quite rapidly, and if that accelerates, then yes, it could lead us into deflation.
Alex, has the Fed's focus now changed from inflation to jobs?
Yeah. I think the focus right now is on jobs. I think more or less, people would expect inflation to be under control. So the situation in the job market actually would determine the pace of this rate cut. So I think people are focusing on that to get through whether we would got 2 or 3 rate cuts this year. So I think the focus would all on the job market right now.
So that means the next jobs report, which comes out on September the 6th, is going to be immensely important, isn't it? Because that comes just before the Fed meets next month. So presumably there's going to be a lot of focus on that. And if it comes in really weak, do you think then maybe a 50 basis point cut could come into the picture?
Yeah, right. I think the job market outlook actually would determine the rate cut outlook right now. So if we are seeing a very weak job market, then probably that would accelerate the pace of rate cuts. So 50 basis point is not out of question. I think people would still expect 25 basis point this time, but I think people would look at the job market closely.
John, how big a concern for you is the jobs market?
Yes, that's certainly very. There's a lot of concern about the erratic, all these revisions of job numbers and so on that have come through, and so there's also concern about how accurate this, the data is on a month by month basis as it's announced. So but they'll want to see. I think they're definitely going to cut 25 points in September, the September meeting anyway. Almost whatever happens, but
And could that
I
be
think he
100?
would-
Could that be 100 basis points? 50 basis points if the jobs data, the next jobs report, is bad.
If it's really, really, really bad, yes. But I think he'd try to avoid creating, just as on the way up, it was slow and steady slow and steady. I think on the way down, they will try to be slow and steady. And I think doing anything else would send that signals again to the market, which could cause volatility. I think he would try to extra volatility. I think he would try to avoid that.
Alex, what are your thoughts on this huge revision in the years? It's a whole year's worth of jobs data, isn't it? From April 2023 to March 2024. The Bureau of Labour Statistics is saying that these gains may have been overstated by 818,000. So that means really jobs have been overstated by an average of 68,000 per month during the revision period. So it brings the average employment growth down to 174,000 when previously we were looking at 242,000. I mean, this is a huge revision, isn't it? So it begs quite a lot of questions. First of all, how has this come about? But also, does it mean really that had the Fed known this, it would have started cutting rates earlier?
Yeah, I think this revision means we probably should not be too reliant on this type of data. And of course, if the Fed knows about that, then probably the rate cut would have come much sooner. So I think overall, the job market actually is slowing much faster than expected. And then I think this kind of statistical method actually need to be a change, and we should not be too sensitive or on one piece of data. I probably really would get through on other set of data as well next time. I think the overall conclusion is that we should not be too reliant on this non-farm payroll.
But the markets do rely on it very heavily, don't they? I mean, it's a market-moving piece of data. So if we can't rely on the jobs numbers, which comes from the Bureau of Labour Statistics, so you would think or hope that would be accurate, what should we look at instead?
No, I think that the point is the market will still be reliant, but as an individual investor, you know that the market may be overreacting. So we probably should be a little bit conservative in reacting to this kind of data. So just bear in mind that the market may be overreacting and not chase the decline or the up move that aggressively. I think that is the way to play.
John, assume we're now going to start seeing rate cuts in September. The market thinks 100 basis points this year. What is the impact going to be on Hong Kong and the Asia-Pacific region of these rate cuts?
I think it'd be helpful for the market, including the property market in Hong Kong. Helpful. I'm not sure it's going to turn things around. The Hang Seng Index is still extremely depressed. There's some signs it's trying to find a bottom. I think once the rate cuts start, and of course that will reduce interest rates in Hong Kong dollars. That might help to boost the market.
Well, what do you think, Alex? There's normally typically rate cuts are pretty good, aren't they, and a weaker dollar are pretty good for emerging markets. What do you think is going to be the impact for emerging markets in Asia?
I think, first of all, Japan probably would underperform a little bit because I think the dollar yen actually would be depressed again. So, and then we probably may see some inflows probably. But I think people would reckon places like Taiwan and Korea actually is too correlated to NASDAQ. So I think they probably may not benefit too much. And for Hong Kong, I think it depends on individual stocks actually. Right now we are being supported by by Alibaba and Tencent, but the overall sentiment towards other techs actually are not that strong. So, and also I think people are still quite worried about the outlook for the consumer market in China. So I think overall Hong Kong may not have too much upside. We may still see those high yielders to outperform, and probably one or two big tech companies will still be okay. But I don't think the overall market would benefit too much because Hong Kong actually has less room to cut rates than the US. So we probably may not benefit too much.
Okay, let me ask you a bit more about Japan. You mentioned Japan earlier. Bank of Japan Governor Kazuo Ueda warned on Friday that global markets remained unstable, and he reaffirmed his commitment to raising interest rates should the country's inflation and economic growth remain on track. He said concerns about a slowing US economy caused the recent market rout, and they're closely watching market moves with a sense of urgency. I mean, John, two things came out of his testimony to the Japanese parliament. One was that Japan's going to continue to raise rates, providing inflation remains sort of on track. And secondly, the market rout was nothing to do with him. So what do you make of his comments?
Well, it's a lot to do with the unwinding of the carry trade. We just sort of suddenly saw, which is not necessarily his fault. That was clearly very overstretched. On the carry trade, and once somebody pulled the trigger, then it had a sort of spiraling effect on the rest of the market as everyone panicked, hitting stop losses and all the rest of it. Caused that sort of plunge initial plunge in early August. So I think we are in for a period of range bound trading at best for Japan and the other Asian markets.
Alex, what did you make of his comments? As I said earlier, two things really. Japan's going to carry on raising rates, and it's not really down to the Bank of Japan that we saw this big sell-off in equity markets.
I think, first of all, he probably will still raise rates, but the magnitude of the rate hike actually may not be that quick given the cuts in the US coming now. So I think market is not too worried about that. So we are not seeing that kind of volatility again in the stock market and also in the dollar yen this time. So we probably would be much under control this time. And for the fall, I think you can only blame the seller probably. But he definitely has triggered the fear at that time. So I think this time, Japan actually may not be that bad. People may not see that kind of sell-off again because people learn the lesson and also control the leverage again. But probably Japan will still be just range bound for a while because I think the dollar yen actually will still be under a little bit of pressure right now. So that would limit the upside in many exporter shares in Japan. But I think overall tone for Japan actually is not that bad. Many companies actually are expanding overseas and they are having quite some achievements. So I think the Japan market actually may not be affected by the dollar yen too much this time.
And how important is the yen to the direction of stock markets elsewhere in the world from here? Do we need to really watch the yen carefully?
I don't think so. I think people probably have learned the lesson, control the leverage, and would not be affected by the headline that easily now. So I think people will look at other markets, other market factors. So I don't think that the dollar would be the determined factor right now. So I think people will have got the lessons. So I don't think that this next time we will see that kind of unwinding.
John, what are your thoughts? Is the yen crucial to where markets go from here?
I would say, I think more important is the dollar generally. We've seen actually quite a dramatic sell-off in the dollar this month. Short term, I think it's probably overdone, and we're due for a bit of a rebound. But this is going to be the direction. It's good for the U.S. stock market to an extent, but we're moving into a sort of different, potentially moving into a different era, if you like, of prolonged dollar weakness, and that will cause, I think, people to reassess their weightings and attitude towards many other markets.
So have the markets now got to adjust? You mentioned now sort of deflation, but at the very least we're in a sort of disinflation cycle. Monetary policy is normalising. So are we going to see some volatility while that adjustment goes on?
Well, we're seeing already the interest rate sensitive sectors, or most of them, maybe not the commodity related sectors, but others, starting to outperform. I think we're also going to see a fairly lengthy consolidation in Nasdaq and the big tech stocks. We saw a very sharp break in early August, and then again the typical sort of rebound. Up 50% or more, even retesting the previous highs. But I don't think we're going to see new highs in the Nasdaq straight away. Possibly a further correction, but a more controlled pullback during the next few months.
Alex, what are your thoughts? As we get higher interest rates, are we going to see a global tech downturn?
I think we probably may see the big rotation to be back. Back in late July, we have a very huge rotation into those valued stocks, and we are seeing the sell off in the tech at that time. So we might be back to that kind of a rotation. If you look at the Nasdaq, actually underperformed the market, underperformed other sectors after the midsection on Friday. And I think it is being supported by the upcoming NVIDIA result announcement. People are not too willing to get out of the tech because we are still waiting for the results from NVIDIA. But I think if you look at the leaders like Meta, it is already showing signs of weakness right now. And actually, the techs outperform other sectors during this round of up move. And I think it's too crowded right now. So people probably would switch out from the tech and go back to those underperformed traditional stocks. So we may be back to that kind of rotation, and that rotation in July actually is very huge, and the magnitude I think is very strong, and that was disrupted by the weak job data later on. But I think people now change the expectation and expect the wake up to be coming more surely. So I think we might be back to the big rotation. So I think I would be very cautious on the tech sector right now, and I would think right now probably Russell 2000 would be the better bets on the US market.
And does that extend to some of the big tech names out here in Asia, particularly in South Korea and Taiwan, like Taiwan Semiconductor, SK Hynix, Samsung Electronics? Are they also going to be impacted by higher rates and therefore need to be avoided?
I think in the long term fundamentals are okay. But I think in the short term, actually, fund flows probably would not be favorable. So I think we need to be cautious this time. I'm not too concerned about the fundamentals, but I think they just got too crowded on this round of rise, and people probably would think there are better values in the traditional sectors. They are more beneficial to the rate cuts, and they are more undervalued. So I think this is a round of rotation based on value. So I'm not saying their fundamentals actually are deteriorating, but I think people probably would think they are just better places to offer value right now. So I think that's why we probably may see these markets to underperform. But I don't think that the fundamentals actually would be deteriorating. Actually, in the longer term, they will still benefit from the AI infrastructure. But in the meantime, fund flows probably would not be favorable.
John, what do you think about the global tech sector?
Yes, I mean, they're all very, very closely correlated, including the names you mentioned. It's basically been the same trade, globally. So if we're calling for consolidation Nasdaq, then we're going to get it in these other names.
And what about What about treasury markets? We're seeing a big move there, aren't we? We've got treasuries now up for the fourth straight month. In other words, yields coming down. That's the longest string of positive returns in 3 years. Can that continue?
I think we're seeing the best of the, this rally is anticipating, quite a number of interest rate cuts. So I think there's room for correction and consolidation there as we move forward. I wouldn't be surprised. So once we get the first rate cut, then you put, sell on the news. So I think the bond market generally is discounting a lot and is a bit ahead of itself. Over, if we're taking the shortest term view over the next 2 to 3 months, but long term, if we're going to see this disinflation stroke deflation spreading around the world, then surely the bonds will be a good hiding place.
Alex, let me ask you about the local markets here. First of all, what about the move by Alibaba to have a dual primary listing now in both Hong Kong and New York, which is to attract mainland stock investors? How significant is that?
Well, I think this is being discounted. Actually, Alibaba results were weak, and the recent strength in the shares is based on the expectation of fund flow from China investors, and I don't think that would be sustainable. Because I think if you look at the numbers from Alibaba, actually it offered not much value. So I think we may see a short-term spike, but I don't think that would be sustainable. I would not be very bullish on Alibaba, but I think in the meantime it would still be supported by that kind of expectations. Actually, I think this is a good time to exit on the strength on these particular stocks. So. And for other sectors, I think we probably may still be conservative on the consumer side of China. So I don't think we may see too much upside in that sector. But those high yielders and companies which are doing more business in the Western world actually would benefit of this one-off rate cut. So we probably may not have too much upside or downside in the Hang Seng right now.
What about mainland Chinese shares? They hit a 6-month low on Friday as measured by the CSI 300, although it then did bounce a little bit off of that low. What's the outlook there?
I think it's still bad because, as I've said, probably the concern is still on the consumer side. And actually, companies' results from that sector are quite disappointing. Mm-hmm. So we probably may still see downward revision in earnings in that sector. And unlike Hong Kong, we are being supported by Tencent or Alibaba. This time, they do not have that kind of stocks. And even though Tencent also rely on the consumer side in China, but this probably will still be the best one to play for that market. And then if the consumer market in China recover, I think the first one to rebound will be Tencent. So I think people probably will still be more comfortable with this one, because if they want to just leave a minimal bets in China consumer market, probably they would just stick with Tencent. So that's why Hong Kong would outperform Asia, and I think Asia probably will still be quite bad.
And let's look at the ALEX index. It's almost a year old now, the ALEX index, isn't it? Consists of HSBC, China Mobile, CNOOC, China Resources Power, Xijing Mining. Since inception in September last year, your index is up 27.1%. The Hang Seng is down minus 0.2% over the same period. So holding pretty good outperformance at the moment, those 5 shares in your index.
Yeah, right now, yeah. And right now, actually, China Mobile are gaining back a lot of lost ground already. And I think China Resources Power will still be okay as well. And Xijing just reported the results, and that was looking quite good. So I think these 5 actually will still be quite good to hold for long term. And with the rate cuts in the US and also the pressing bond yields in China, I think these 5 stocks actually will still be okay.
John, final thoughts from you on the China markets and the local markets here. As I just mentioned, the CSI 300 hit a 6-month low on Friday. Do you see any sort of upside at all from here?
Little, I would say. The bear market sort of slowed down, but that's the way it is. Yeah, it is concerning. There's no seems to be no upside momentum at all, or just slowly still grinding lower, and don't see a catalyst in the near term to turn that round. But as I say, I think the outlook is going to be slightly better for Hong Kong, and certainly I agree that high yielders, value stocks, interest rate sensitives will be the names to go for.
Okay, well, thank you both very much. Have a great week. You heard there John Schofield, who is Managing Director at Tempus Investment, and Alex Wong, Director at Alex K.Y. Wong Asset Management. I'm joined now by Ben Cavender, who is the Managing Director at the China Market Research Group up in Shanghai. Morning, Ben.
Good morning.
Now, we had Jerome Powell's much-awaited speech at Jackson Hole on Friday. The key takeaway there was he said the time is right now to start cutting US interest rates, although he didn't give us much guidance on the path of interest rates and how low they're going to fall. But nevertheless, what impact will this have on the China markets?
I think hopefully it should make things a little bit easier for China from a policy perspective. If rates go up in the U.S., it gives the government here a little bit more leeway to play with the relative strength of the yuan, which I think is good because I think up until now there's been quite a bit of downward pressure on the currency, which hasn't left the government much room as far as what it can do to stabilize the economy more. On the other hand, I think if we do have the U.S. slowing down maybe more than was indicated by those Fed notes, it could be an issue because it could mean that perhaps demand for Chinese exports also slips a little bit. And right now, I think Chinese exports and manufacturing are pretty much the only thing driving the economy right now.
And you mentioned the yuan. I mean, this is key, isn't it? That maybe this will help take some pressure off the yuan and give it more room to make some policy adjustments.
Yeah, and I think that's needed because certainly right now the sentiment on the ground is still fairly weak in regards to China's economy, and I think a big part of that problem has been they haven't been able to do much in terms of fiscal policy or in terms of adjusting the relative strength of the currency. And so this should help and give at least a little bit of room rather than things sort of being totally outside of their control.
They left the loan prime rate unchanged last week, although, to be fair, there are record lows now, aren't they, following the unexpected rate reduction in July. Pan Gongsheng, he was talking about not wanting to take any drastic measures for the economy. What did he mean by that?
I think there's just been, over the last year or more, so much discussion around, is China going to do some kind of, large effort like happened in 2008 or sort of during COVID. And I think the reality is they don't want to do that again. They're still very worried about systemic risk, about there being too much debt. And so there's a feeling, well, if they do too much now, it kind of undoes a lot of the hard work and pain that they've kind of taken to sort of keep things stable. So I think the reality is you're going to see, very targeted investment in infrastructure, very targeted investment in kind of helping to bail out companies or industries that haven't been doing that well, targeted investment in high-tech industries to create jobs. And none of that probably is going to do too much to really increase the overall speed of the Chinese economy. I think right now, more than anything, we have a sentiment problem here. But I think they just want to be making it clear that whatever they do, it's going to be relatively small scale.
I mean, when we look at the data, the July economic activity indicators for China, it sort of suggests that really the third quarter has got off to a rather sluggish start. It wasn't particularly optimistic, was it, the data? What's your sort of take on that and where the Chinese economy is right now?
Yeah, I mean, I think, when we speak with company owners, whether they be private domestic companies, state-owned enterprises, international firms that are operating here, I would say by and large, the overall sentiment is things are still slow. They're going to remain slow. We're not in full-on crisis mode, but there's also not very much in the very short term to be optimistic about. With maybe the lone exception being, I think some companies that are sort of in like high-tech industrial products, that kind of thing, maybe are doing pretty well. But almost everybody else, especially anybody that's consumer-facing right now, I think, frankly, is really struggling.
And the other disappointing aspect from all that data was that real estate, which people hoped would maybe sort of be reaching some sort of plateau, some sort of inflection point, it actually worsened. It was down, investment in real estate down over 10% on a year-on-year basis, and property sales plunged once again in July, down almost 26%. There just doesn't seem to be a bottom there, does there?
Yeah, I mean, well, and this is the flip side of the run-up that we've had over the past 20 years or so. I think people assumed, well, sure, maybe prices come down this year, but real estate, long-term bet on China is still good. But it just discounts just how much real estate has been run up and speculated on over the last decade or two. And so I'm frankly not that surprised. There isn't that much confidence from the population that would normally support that market, and I think it's still going to take some time before that confidence returns.
And from an investment point of view into Chinese equities, again, it seems pretty gloomy, doesn't it? The CSI 300 hit a 6-month low on Friday, although it did rebound off of that low just a little bit. But there doesn't seem to be much optimism around about China's equity markets. What are you seeing from over there?
Yeah, I mean, we obviously for a while had a big sell-off, and a lot of institutional investors from overseas moved out of the market. Then they decided, okay, we've had enough of a sell-off. It's time to come back in. The problem is there just isn't enough sort of long-term support evidence from sales strength or sales opportunity to kind of support the valuations that exist right now. And so I think now you've got investors sitting on the sidelines again saying, okay, we're really looking for more signals that things are going to get better, and those signals just aren't there right now. I'm still long-term very bullish on China, but I think in the near term, the next year or so, there are a lot of questions, and I think there's a lot of just negative sentiment that has to be worked off before you have consumers opening their wallets, companies being willing to take loans and make investments in new business operations. It's just going to take time.
And how much is sentiment being damaged by the clampdown on various types of activities into the China market? I mean, mutual funds are being really squeezed. Certain types of quant funds can't trade anymore. It's making all sorts of fundraising at the moment very difficult. And then on top of that, you have restrictions on data that can be disseminated about the markets. How much is all of this impacting sentiment?
Oh, it has a huge impact. I think it's already a risky market to invest in because it's economically it's turbulent times, politically it's turbulent times. So we just don't know what's going to happen with trade wars, tariffs, anything like that. And then on top of that, if you're an investor and you're investing based on access to information, you don't have that information, it just adds additional risk. And so I think you have a lot of professional investors that are looking at the market saying, yeah, sure, we'd love to have a position in China, but we can't actually analyze right now what it is we should be doing. And we don't know from a policy perspective if things are going to be harder or easier tomorrow or next week or next month. So it's realistically very difficult for us to be playing in that sandbox. So I think that's a reality too.
I mean, for foreign investors, it must make it almost impossible to be able to go into the market at the moment.
It's quite difficult. I mean, we do research for a variety of funds and fund managers that want to have better access to the market here, but the reality is that most funds just can't really do that or get that level of granular information, and so they're just sort of putting their hands up and saying, we can't do it right now. Or they might get their exposure in other ways by investing in sectors or markets where maybe Chinese companies have IPO'd overseas and they have a significant amount of international sales or something like that. But it's tough right now.
And what about the bond markets? I mean, that's been a bit of a haven, hasn't it, for funds and banks, particularly rural banks that haven't been able to lend, can't do anything in equity markets. They've gone into the bond markets, but that seems to be being squeezed as well now by the PBOC. They're saying that's reckless investment.
Yeah, it's kind of like there's nowhere where anybody can feel safe putting their money and kind of getting a guaranteed safe, if not amazing, return. It's just it's everybody's sort of fighting for scraps right now, and I think it's on the one hand it's quite difficult from a business perspective. On the other hand, it's sort of funny to look at because the reality is, it's not like the economy here is coming off the rails. I think a lot of international sentiment is, man, China's just totally falling apart. The reality is there's a lot of growth in second tier and third tier cities here right now. Business activity is continuing. It feels like there's a lot of like organic life on the ground. It's not like people are just sitting at home crying. But on the other hand, there just isn't a lot of sort of positive sentiment like there was maybe 10 years ago, with people saying, oh man, the economy is really kind of chopping along and there's a lot of growth opportunity.
Now, what about the political front? We had the Democratic National Convention last week. Kamala Harris made a speech as she accepted her nomination to be the candidate for president. She said as president, she's going to ensure America, not China, wins the competition for the 21st century. She criticized Donald Trump for cozying up to authoritarian leaders, saying he was going to be one of them themselves. This seems to indicate maybe not going to be an awful lot of change in policy towards China if she wins. How's that being taken over there?
I mean, I'm sure it's, like on the face of things not being taken well, but I think also on the other hand, probably there's some recognition that given that it's an election year and China is sort of a favorite target for politicians in the U.S., that there's going to be a degree of grandstanding and saying things that may not actually reflect what happens on the ground. I think that, long term, assuming there are sane people in power in the government in the U.S., there's a recognition that they do have to work with China economically and politically, and that it's much better if the two countries are connected and growing together. Having said that, I do think that the Democratic Party in the U.S. has a little bit of more of an ideological tinge against China and China's system. The question is just going to be how much that actually plays out from a policy perspective.
And we've got the U.S. National Security Advisor, Jake Sullivan, traveling to Beijing this week. I think he arrives tomorrow. He's going to meet with Wang Yi and other high-level officials. It's the first time in nearly a decade that someone in his position has gone to China. So how significant is this likely to be? And will it help smooth relations between China and the U.S.?
I think it's very significant when anybody high level comes over, especially if it hasn't been for quite a long period of time. Because I think on the one hand, you might have Kamala Harris saying something that plays well to the crowd in the U.S. and sounds quite unfortunate to Chinese politicians. On the other hand, by sending a very senior official over like that, you're also giving a lot of face and you're recognizing that the relationship is important. So I don't know if anything substantive necessarily would come out of the talks. But I think the fact that the dialogue is happening actually bodes well as far as just a general level of communication, and we're in this together, even if we don't agree on certain points, versus we're setting up to just be totally at odds with each other.
And could it potentially lead to maybe another meeting between President Biden and President Xi?
Never say never. I wonder with Biden kind of, being in the sunset of his career, if that's something that he would like to add to his legacy versus at this point he's tired. He's sort of, a little bit going out as a lame duck in the sense that he wants the entire discourse to be shifted towards the coming elections and how to get Kamala Harris elected. So I really can't say, but I tend to suspect no.
I presume that during this meeting as well, one of the things that'll be on the agenda was the Friday announcement from the U.S. Department of Commerce that they're going to add another 105 Chinese and Russian entities to its export control list, which it's accusing them of helping Russia in its fight against Ukraine. The U.S. The Chinese Ministry of Commerce Sunday said it strongly opposed that. I presume this is going to be high on the agenda as well.
I'm sure it'll be high on the agenda, but at the same time, I think the various levels of relationships between all of these countries and how they're acting to support or not support each other has sort of been in flux in various ways over the last couple of years of this conflict anyway. I think, the Chinese probably will continue to, look at ways to do business with Russia. On the other hand, I think you've seen a lot of the Chinese banks really backing off on handling transactions with Russia. So on the one hand, I think the Chinese will not be pleased to have companies added to the list. On the other hand, it seems like in the background, they may also be sort of reducing a little bit the level of support they're giving anyway.
Ben, always a pleasure talking to you. Thank you very much indeed.
Thank you.
That's Ben Cavender, who is Managing Director at the China Market Research Group.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves. That's all in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Alex Fu McMillan, a freelance writer and Asia columnist for TheStreet.com, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Woods. See you tomorrow.
Money Talk